All right, guys. So what I want to do is make this a little bit interactive. We'll have questions and comments and things at the end. It's important for everyone here because the 2026 forecast, I'm going to focus in on the things that move mortgage rates because as mortgage rates go, the housing market kind of follows, as we'll see from some graphs. And you see every day, but we'll show in graphic form as well in just a minute. So as one thing happens, the housing market follows suit. So what we're going to focus on especially is what's going to move mortgage rates eh, above all the two main movers, right? And one of the main movers is inflation, the other is jobs, the jobs market, unemployment or employment, as the case may be. And oh, there we go. Figured out how to move this. So I got a lot of these numbers from MBS Highway. Barry Habib, some of you may be familiar with Barry Habib, some may not. He runs what's called MBS Highway. That's who I go to daily for just an update on the mortgage-backed securities, those bonds that move mortgage rates, where they're headed, what's moving them, what are we expecting, etc. And Barry is certainly not always right. However, he has a track record over the last 7, 8 years of being more right than most economists, he and his team. And so, in order to set that stage, I wanted to show you what they predicted last year at this time. And what they said, and they do a deep dive into all these numbers as to why, and really a nice deep dive. But here's what they projected last year. Their forecast was that the 10-year Treasury would be at 3.8% as a low sometime during 2025. It didn't reach that, but it did get to 3.89. So not far off. That was a pretty good number. Um, what they also forecast was therefore 30-year fixed rates would reach a low of 5.75 to 6%. We didn't get there. We did in January, but not in 2025. We got to 6.1 as a low. That was back in September, as you may recall, because things picked up when that happened. And then a mortgage spread. I'm going to talk more about this in a little bit, but some of you may know, some may not. There's typically a spread between the 10-year Treasury and mortgage rates. And that spread historically is 1.6 to 2%, kind of a range of 1.6 to 2. It started off last year at 2.8%. The MBS Highway team thought it would get to 2.25. In fact, it was a little bit less than that. It dipped to 2.20. So again, pretty close there and pretty close on. Now, home appreciation nationally, they forecast 3.5% that home prices would go up in 2025. According to Redfin, they didn't. They went up 2.6%. So that was their biggest miss. However, I would argue if we had hit 5 point, oop, sorry, if we had hit 5.75, home prices would have appreciated more rapidly, but we didn't. So I think that was a miss together with that interest rate target. So the unemployment rate finally, because unemployment and inflation are the two biggest things that move mortgage rates, move bonds, right? And move the Fed and cause the Fed to act or not act. They projected unemployment at 4.5%. In fact, it went up a little higher. 4.56% was the height. So I say that to set the expectation. That was their projections last year. Are we going to be 100% right this year? No, but hopefully as close as last year. So before we get into inflation and unemployment, what to expect there, and therefore what rates would do, and therefore what housing would do, there are some outliers or some new things being introduced, right? Trump said a month or so ago he wants the government, I'm assuming the Treasury, to buy $200 billion worth of mortgage-backed securities. Those are the bonds that move mortgage rates, right? So you introduce a new buyer, and all of a sudden, you can see from this Bloomberg chart, they haven't even spent a dime yet of that $200 billion, and yet the bond market foresaw that, and the spread between treasuries and mortgage rates dropped. Therefore, mortgage rates dropped and dropped nicely, I must add. Um, it's nice to lock things in the fives, not the sixes. I've been enjoying that. As well as the big thing, there's a proposal to ban institutional investors from owning single-family homes, as you all know. And the proposal is no one can, no institution can own 1,000 or more single-family homes. So we don't know what that's going to look like, but if that means they have to liquidate, well, that'd be 345,000 homes that would all of a sudden hit the market. That makes a dent in the market. It doesn't make a huge impact, but it certainly makes a dent in favor of more inventory, right? So, oh, by the way, the transition slides here. Last year we went on a cycling cruise to Spain, Morocco, and Portugal. So we took some photos and thought we'd use those as the transition slides. So enjoy the transitions here. It was a fun trip. It really was. Oop. So the first thing is, what's inflation going to do? Well, the PCE numbers, right at the moment, personal consumption expenditures, is one measure of inflation, and that's the Fed's favorite measure of inflation. And the headline is 2.8% right now. The core is just stripping out the very volatile things of food and energy, arguably the most important things to us as Americans spending our money every month, but stripping out food and energy, it's still 2.8. And you can see the consumer price index is the other measure of inflation, and the headline is 2.7, stripping out food and energy is 2.6. But here's the interesting thing that the guys at the team at MBS Highway has been harping on for several months now is that shelter is lagging and the Fed is not taking into account the true cost of shelter, which is going down. Um, and this is what I mean. So shelter, by the way, the Bureau of Labor Statistics samples 1/6 of apartments and housing and rents across the country every month to come up with a shelter number. So 83% don't get included, you know, only 1/6 does. And basically what they're coming up with is new rents have dropped 1.3%, and then renewals are up 3%. So the average is still up 1.9%. But, oh, that's, the real numbers, the actual numbers, I think. But what the Fed is looking at is 3.7% still. So it's quite a bit higher than that 1.9. And you might ask, well, why are new rents dropping and renewals still going up? Well, simple. Landlords can do that, right? Someone in an apartment looks at an increasing bill for the next year and says, well, I don't want to pay it, but it costs me more hassle and time and money and renting, moving trucks and everything to move down the street to a new apartment. So I'm just going to pay it. So rents, shelter is going down. Tariff is also something that was priced in by the Federal Reserve quite a bit, and it seems to be going down. So if that is overstated by 0.3%, shelter is overstated by 0.3% portfolio management, really the core PCE should come down to 1.9. Now, all that's not going to happen at once, so the 12-month forecast is about 2.5%, maybe 2.4 if we round down and we get a little under 2.5. Anything under 2.5, the Federal Reserve is going to say, look, their target is 2% inflation. We all know that. It's said over and over by everybody. 2% inflation is the target, but anything under 2.5, the Fed is going to say, a year and a half ago, we were at 8%, 2.5 or less, we're good. So we don't have to slow the economy down. And the way they do that is raising rates or quantitative tightening. They've stopped quantitative tightening. They've been lowering rates. We'll see what happens from here. So then we talk about labor. Oh, by the way, if you have the chance to go to Barcelona and see Sagrada Familia, it's cool. And I included it in this slide because, hey, they're about to finish this. I think after 140 years, it's been under construction, and it's due to be finished in 2026. So if you ever get a chance, that was an impressive sight. But we're talking about labor, and that's why. So labor. What we're seeing is this trend since the middle of last year is it's harder to find a job when you're let go. When someone's let go from the job, it's just harder to find a job. So they apply for unemployment. Then unemployment benefits last 20 weeks, at least in South Carolina. Um, and then, but a lot of times what we're seeing is those don't cover it. They don't cover your expenses. And so there's a lot of people um, jumping into the gig economy, right? They're driving Uber. I know two realtors at least who are renting cars on Turo. They're, you know, colleagues in the office and your brokerage who are doing the same thing. And that's not just limited to real estate. That's everyone, right? Is jumping into starting their own business or a side hustle or something like that. It's just harder to find a job once you've been let go. So people are jumping into that. Why is it harder to find a job? Well, there's less job openings, jolts, right? The job openings have been declining quite a bit for some time now. In other words, once an employer lets someone go, they're not replacing them, at least not at the same rate. And that bodes negatively for the job market. But again, that's positive for the housing market because it's positive that the Federal Reserve is more likely to continue to drop rates as opposed to turning around and needing to stimulate or slow down the economy rather. They need to stimulate by dropping rates. ADP, this is interesting. I like ADP payrolls better than the BLS payroll numbers. I think they're more accurate. But look what's been happening in the last 6 months. Um, we have one, two, three, 4 out of the last 6 months, well, 7 months, has been negative. In other words, a net job loss as opposed to job gains, the red line being zero. So if that trend continues, it doesn't bode well for employment, but it does for housing. And again, the BLS jobs is over, the BLS jobs is overstated. And this is what I mean. Do you remember a few months ago, I think it was March of this year, they revised, the BLS revised their job numbers down by 895,000 jobs. In other words, they said we created 895,000 jobs as a country that never got created. They never existed. And so they do two revisions. They come out with their number and then revise the next month and revise the month after that. And the revisions have all been downward. So I think, jobs reports are weak, but still being overstated a little bit, at least by the BLS. I'm going to skip this one. The birth death ratio is getting too much in the weeds. We'll skip over that for the moment. But the unemployment forecast, it was 4.5, it was 4.5% in November, dropped to 4.4 in December. The forecast is that we continue going up to about 4.8%. Why does that matter? Again, just to restate it, if the economy and jobs are hurting, the Federal Reserve has its duty to stimulate the economy. How do you do that? Cut the Fed funds rate. Is that the mortgage rate being cut? No, we all know that's not the same as mortgage rates. However, it has an effect, a fairly direct effect. Oh, that was in Tangier after riding all the way across Morocco, which was fun. And I highlight a few of these just for fun, as it was a great trip. Um, so what we do know is Jerome Powell is on his way out, right? Trump and Powell don't like each other. No one thinks they do. They're not very uh, quiet about that. They're both pretty boisterous about that. However, we don't know who the next Fed chair is going to be. However, we know he's going to be fairly dovish. We know that for a fact. I mean, Trump's going to put someone in who wants to cut rates, not keep them the same or increase rates. But that guy is not alone, guy or gal is not alone. There's also all the voting members, right? The New York Fed chair, John Williams, the New York Fed chair always is a voting member. Then the governors always vote, and then they rotate out. Some of you know this, some don't. But every year that some of the Fed chairs rotate in and they're voting members, and some rotate out and they're not voting members. The voting members for this year include, obviously we have Bowman and Waller, who are governors. They always vote. And then Anna Paulson in Philadelphia, she's been known to be very dovish. She wants to cut rates. And then centrist kind of could go either way, are the two governors, Barr and Jefferson, and Kashkari is kind of a centrist as well up in Minneapolis. And then you've got some hawks, right? Lisa Cook, Beth Hemmick is super hawkish. She wants to raise rates and I don't know what. Um, However, these centrists are kind of the key. If unemployment keeps going up, they're more likely to want to cut rates, and that helps mortgage rates. So here's the Fed funds forecast for MBS Highway for this year. 3 rate cuts, 3/4 of a point total in rate cuts by the Fed funds. Does that mean mortgage rates go down 3/4 point? No, it doesn't, but it will help mortgage rates go down. And I'll get to that, how much, in just a minute. Now, I will state this. There are a lot of economists who expect a 1/4 point rate cut in 2026, and that's it. That's the end. So 2.875, 3/4 point rate cut is pretty aggressive, but I tend to agree, and I think we're more likely to get there, especially with the new Fed chair. Yeah. Oh, I was over in Gibraltar and I met one of your home sellers who was having a bad day, kind of monkeying around and being like, "Hey, why haven't you sold my home yet? What?" And so I thought I'd share that. And, yeah, sometimes home sellers can be that way. So this is Barry Habib, who runs MBS Highway. I don't, many of you know him, some may not. And he was meeting with Scott Besson. Scott Besson thinks the 10-year Treasury rate will reach 3.9%. That's kind of his target for this year. Barry thinks we'll be a little bit below that. I tend to agree with him. Fingers crossed, I hope so. But here's what will influence that, right? We know we're going to have additional debt as a country because the US government seemingly never spends less, always more. That's a bad thing for rates. That's not good for rates. It's bad. However, the rest of these things can be good for rates. In order to fund the spending, we have to issue more debt. But the debt doesn't have to be more 10-year Treasury bonds. It could be shorter term bonds. And in fact, Besson is kind of leaning more toward shorter term, 2-year bonds, etc. So if it's shorter term debt, it turns over more quickly. And that's a good thing. The Genius Act is also out there, stable coins, right? We're looking at introducing more stable coins, and those are backed by dollars and specifically treasury bills. So if banks start adopting the stable coins, they have to buy more treasuries, specifically short term. And then if the unemployment rate goes up, what's the Fed's only quiver, it seems these days, only arrow in the quiver, rather? Well, quantitative easing, right? Printing money. And so that bodes well for mortgage rates and for home prices to go up, by the way. I could talk more about that in a minute. By the way, when the Fed prints, this is an aside that's I think is interesting. Everyone says that home prices continue to rise, and certainly they do, but you can look at it a different way. And this is important if you get the engineer type who's like, well, I'm not sure home prices will rise. Say, well, what do you think the dollar is going to do? And most engineers who pay attention to the economy will say, oh, well, the dollar is going to keep being debased. It's going to keep being worth less and less, right? Because we're printing more and more money. So therefore, the dollar simply, every single dollar is worth less. And I would argue, okay, great. So home prices aren't going up. Home prices, let's say, are staying stable. But as the dollar is worth less, it takes more of those dollars to buy that single piece of property that you're looking at right now. So if the dollar keeps going down and the value of a real asset like a real estate property stays stable, it's going up in real dollars. So it's worth more. So therefore, the price of the home is worth more. Not because home values are going up, but because dollar values are going down. Okay, and finally, bank deregulation is on the table. Banks can only, they take in deposits and they can only lend out or purchase so many assets with those because they have to have some reserves. Well, the bank deregulation that's on the table right now says, yeah, but what about treasuries? Treasuries are backed by the full faith of the U.S. government, full faith and backing of the U.S. government, and therefore they're risk-free or practically risk-free. So you should be able to buy more treasuries, and that would bring more demand, more buyers into the market, banks, by buying more treasuries and therefore pushing the 10-year treasury rate down, and therefore mortgage rates follow suit. So where does MBS, how we know where Scott Bessent thinks the 10-year Treasury will reach, I was going to say end, but reach sometime in 2026, 3.9%. A lot of economists, 3.8. MBS Highway thinks 3.7, and then an outlier, maybe 3.6%. Why is that important? Because there's a spread between 10-year Treasury and mortgage rates. And as that spread continues to go down and the 10-year Treasury goes down, mortgage rates go with it. Here's the spread. So the spread is typically, kind of historically, about 1.6 to 2%, right? Whatever the 10-year Treasury is, add 1.6 to 2%, let's say 2 for easy math, and that's where mortgage rates are. Right now it's higher than that, and it's been quite a bit higher than that, as high as 3% over the last few years. And that rates were so much out of whack, and that's where rates were 7 and almost 8% 2 years ago, if you remember. That was no fun. But as we come down into this range, it means nothing else has to happen. Just the spread tightens to back into range bounds and mortgage rates go down. So where are they going to? Well, if MBS Highway team is right and the 10-year Treasury goes down as low as 3.8%, and the spread goes not to 2, not to the middle of that range, 1.8 would be the middle between 2 and 1.6, but just to the top of the range, 1.9, then mortgage rates should reach about 5.7%. And some of you might be saying, well, wait a minute. I had a buyer lock in at 5.75. Yes, government rates are always lower than conventional rates, and this deals with conventional. Government rates, it's worth mentioning, are rates backed by the government, VA, FHA, and USDA. They're always lower than conventional. And I've been locking rates in the fives on FHA and VA for 2 weeks now. It's been fun, but we're not quite there on conventional. Could we get there? Yes. But what if the 10-year goes to 3.7 and the spread narrows to 1.8? Well, suddenly we're at 5.5% on a 30-year fixed rate. So somewhere between 5.5 and 5.75, I think, is very realistic to reach on conventional rates sometime this year. So what's the rate forecast by everybody else? Well, Fannie Mae, I'll talk about this in a second. It says we'll reach 5.9, National Association of Realtors 6, Zillow 6.13, Realtor.com 6.14, Mortgage Banker Association 6.4. The average is 6.17. Here's an interesting tidbit. Barry Habib, who helped put these numbers together, was named to the board of directors of Fannie Mae about, I don't know, 3 or 4 months ago. And Fannie Mae's forecast was 6.4% until Barry got on the board, made his arguments, and they lowered it to 5.9. MBS Highway is lower than everybody else, says we'll be at 5.7, most likely sometime during 2026. That'll be the low point in rates. And I tend to agree. Now, what's that mean for everybody? Well, for your past clients, it means somewhere between 8 and 9 million people would be eligible to refinance and save quite a bit of money, at least 0.75% in rate, right? That's substantial, especially, and here's what I'm doing this year. I started last year because home buyers, homeowners, home sellers are all nervous, more so than I've seen in years, because A, they feel like they missed out, right? Home buyers especially feel like, oh, I got out a 3% rate had I bought just 3 or 4 years ago, and they miss out. And some home buyers are waiting for rates to go back to 4%. Well, I got news. They're going to be waiting for a while. But what we can do is serve our past clients very, very well by saying, hey, I keep an eye on these things. I know rates are very, very likely to go down this year to a point where it's going to make sense to refinance and save quite a bit. I want you to be aware. And by the way, if you do that with your past clients, I would love to apply to be a lender that you refer them to so I can help them refinance. That's my shameless plug, but I would like that very much. But that's a very, very good way to stay in touch with your previous buyers. Have an in-depth conversation with them, not just, hey, who do you know who needs to buy, sell, or refinance? but have an in-depth conversation that's serving them. What do they do in return? Well, they send to their friends and family. The other thing to keep in mind is a lot of people are nervous in a good way sometimes about what is my home price doing. So if you want list reports for all, list reports gives you a lot of information, collateral, I should say, for your new listings, and it's automatic. If you sign up for it, it just emails you and says, here's listing flyers, here's a single family website for your listing, here's all these things you can use to promote, but it also helps your home owners because every month we send them an email that says, here's what sales have been in your neighborhood. Therefore, here's where your home price is headed. It's headed up or down or steady or whatever. And this gets a lot of opens, like 80 some percent open these emails. And your information is in front of them for supplying it every month. So I say that if you want this, let me actually add this in the chat. I think I have it. If you're interested in that, take a look at it. Yeah, with the link that I just put in the chat. I think it's a good way to serve your past clients and remain in front of them so we get more referrals this year. Okay, so finally, real estate forecast. And with this, we'll kind of wrap up, and I'd love to hear your comments, questions, etc. By the way, this was Montserrat. If you ever get a chance to go up there, it's really beautiful. So household formations drive the housing market. We all know that, right? Someone gets out of college, gets married, they leave the living up in the frog in their parents' house, and they start their own household. They form their own household. They go buy a house or rent a house. And that's fallen off a cliff, that demand. But the other way to look at that is there's a lot of pent-up demand just waiting for the tide to turn. And a lot of people, I'm convinced, I think you are too. I would love to hear your take on this. I'm convinced there's a lot of people who are waiting for the feeling to turn, the news cycle to turn, to stop saying housing might crash, housing might, whatever, but to say, oh, you know what? Housing's looking good again. And then they buy because it's an emotional choice largely for a lot of people. But I think there's a lot of pent-up demand. And again, the graph just kind of shows it. Housing starts are way down. You wouldn't know it driving around Charleston here, but they are nationally. Housing starts are way down below. So new supply coming on is not keeping up with demand. And therefore, I think we'll see a lot of people starting to move their existing homes, and we'll see a lot of existing inventory hitting the market that hasn't been over the last 3 years. People have been sitting on their 3.5% interest rate because to go from 3.5 to 6.5 or 7 felt just wrong. But to go from 3 something to 5 something, it's more palatable. So I think we'll see a lot more inventory of existing homes coming in the market. But look at what happens every single time the mortgage rates drop. Demand goes up. In other words, pending home sales rise, right? We saw it back here, and it really happened in September of 2023. And back here, September of last year, we saw rates drop again. Pending home sales went up. Now we're seeing a huge drop in rates, bigger than the last 3 years, and pending home sales are up again. So I think this bodes well for 2026 if rates do drop to, anywhere in the fives, high fives. 5.75 would be ideal, but even 5.99 makes a difference, and it feels good to home buyers and home sellers. So I think we'll see that continue to rise. Here's the forecast by everybody else, right? National Association of Realtors says existing home sales will increase by 14%. Fannie Mae says 7.8. We got Realtor.com saying much less. Bright MLS, I'm not even sure what that is, says 9%. The average is 6.63. But home price, here's what I would argue. Are homes still a good investment? Because I'm still talking to people, and I bet you are too, who are like, man, the homes went up 20% in like 2 years during the pandemic. I wish I'd bought then, but now they're done. Well, no, over time, if you're going to be in a home for 7 to 10 years, which most home buyers are, you'll see appreciation. MBS Highway predicts, same as last year, 3.5% appreciation year over year nationally. And here in the Southeast, and again, I've got, I think, some realtors on from Florida and Georgia. I lend in Florida, Georgia, as well as South Carolina. So I kind of look at the Southeast, and it's kind of across the board. Now, Florida has dropped more than anywhere else, but that Florida is volatile. It means it's probably going to rise quicker than anyone else. But about 3.5% nationally is what they're predicting. We'll see home price appreciation year over year. So here's a summary of the forecast. Unemployment rate will rise to 4.8%. Will it be exactly that? Probably not, but probably pretty close, I think. Core PCE inflation numbers, 2.5, maybe even 2.4. Fed, and both of those things bode well for the Fed funds rate to drop more significantly than a lot of economists are expecting or anticipating. And finally, mortgage rate of around 5.7% as a low. Now, you know as well as I do, when we hit that low, I'm encouraging people to lock because we don't stay there. It's never a straight line. It's always a jagged line, whatever, that. Rates move every day. And then home price appreciation at 3.5%. So that's pretty much it. I would love to open it up and just hear your comments, questions, what you're seeing, what you think of this, etc. If you're still running into people like I am, who are like, well, I'm holding out for 4% rates. Like, okay, well, you're not a client because you're be holding out for years.
Jim,
Yes, Alan, how you doing?
good. How are you?
Awesome.
Um, I don't know what others think, but I think that the market is it's a little bit um, hyper local. So I see a lot of activity in the higher price range, but those prices are not as stable for some reason. They have more discount,
Yeah,
and also their prices are probably going to come down a little bit on the high end.
yeah.
Even though there's more demand, which is kind of unusual. And the
I've
bottom
been
end
seeing the
of
same.
yeah, the
Yeah,
bottom end of the market, I still feel like, you know, things are going well.
yeah,
Uh, Prices seem to be going up normally. I mean, it's back to a normal market, I guess, where you put your house on the market, it might take a couple of months to sell. You might have to negotiate 3 to 5%. That's all normal.
that's normal. Yes.
And
And
so
that's where you come in, by the way, because for a while it wasn't normal. And that's where a good agent, whether you're a listing agent or a buyer's agent, still giving counsel. So many people need that because there are I'm preaching to the choir here, Alan, of course, but I see it and you see it every day. So many home sellers still think they can get this abnormally high price and not pay anything, not pay any contribution to closing costs, etc., or repairs or whatever. And they can't. And so that's where you come in and your expertise. I think that's where, and I know I'm stealing your thunder here for a second, and I want to hear the rest of yours, but I think that's where you guys, with you, Alan, specifically, with your years of expertise in the market, can really set yourself apart and gain market share this year, especially. Whereas the last 3 years, it was kind of like, we're all just treading water here. But your expertise is going to really gain a lot more listings this year, I think.
let's hope so.
I tend to agree with you, and I'm seeing the same. The high end market is kind of volatile; it's all over the place. The low end market, we did a flip. It's not exactly low end, but we just did a flip that closed right before Thanksgiving, and the recommendation was to list it at 480,000. We were like, we just wanted to move, so we listed, just under 450, 449.9 or whatever, and and it like that. I mean, it was gone, but we had to pay some closing costs, but we knew that going in, it was factored in. Yeah. And that's just anecdotal from personal, but you know what I mean. I totally agree. Yeah, Sherry, I agree with you too. It depends on the area. Um, Anything else you got, Alan?
Oh, this is interesting. I mean, we got to keep our ears to the ground as to what's happening in general because things can be very volatile. I mean, things might happen tomorrow that throws all this off. So it's
Yeah, that's for sure, for sure. And I was talking about, thank you for saying that. I was talking mostly about, the two main drivers of what the Fed does, and therefore what mortgage rates, the direction of mortgage rates, which are inflation and labor, the jobs market. But we know there's also QE, which is almost certainly going to happen this year. It's an election year. Trump administration definitely wants the housing market to be strong. But what about the unknowns? What if China invades Taiwan or something? That's the unknown that you can't plan for.
yeah. I mean, when you cannot control things, all you have to do is keep aware of them and report, you know.
Yeah. Hey, Sherry, you want to unmute and jump in and talk about that? Because you're absolutely right. Um, Consumer debt does have a big impact on the ability to buy. I don't know about lower price points. Oh, I see what you're saying. On the ability to afford a lower price point. Yeah, you're right. We're at 1.3 trillion in credit card debt as a nation. Um, and anecdotally, I'm seeing more and more car payments well over $700 a month, which to me is just like, wow. I I closed one. I was telling someone this. I closed one um, recently. The person had three car payments, husband, wife, one of the kids, and they were all over $1,000 a month. I was like, like, yikes. The kid does not need a nicer car. I guarantee it. Hey, Sherry, I can't really hear you if you're talking to us.
I'm not. I didn't get
Oh.
that. Could you try again?
That's Siri, not Sherry. All right, guys. Anyone else have any final thoughts or comments? I'd love to hear them if you do.
Jim, this is Eric. I just want to say thanks for putting this on. Great information. A lot of food for thought moving forward.
Thanks, Eric. Appreciate that. You're awesome. And all right, guys. Well, it's going to be a really good 2026. Again, I'll wrap by saying what I said before. I really, really think that this is a year where our expertise in counseling people and making introductions to people like financial planners, like good insurance people, like etc., is going to be key. It's a team effort this year more than ever, but I think as a team we're going to grow more than ever because those referrals go back and forth, not just one way. And that's what I'm focused on is every single client gets introduced to the right professionals that can help them continue to build wealth, not just in owning a home, but in other areas of their life as well. And I think that's important for all of us to do this year. So it's a team effort. Thank you, guys.